My name is David Hawa, Senior Fixed Income Client Portfolio Manager at Robeco. Today, I would like to discuss the importance we attach to the Robeco Credit Quarterly Outlook. This analysis identifies the current phase of the credit cycle that we find ourselves in: bear, recovery, or bull phase. When we look at what happened in fixed income markets this year, it's been generally disappointing for this first half of the year. The year of harvest after the very tough year of 2022 simply has not materialized. Inflation still seems to be with us. Our view is that things could change for the rest of the year. Central banks could be finally winning the battle against inflation. Looking at government bond yields, they have increased, and we believe the time to harvest these is becoming closer and closer. Currently, our analysis indicates that we're approaching the end of a bear phase, and so therefore, we're implementing what we call more of a prudent approach. The way we express that is that we are favoring investment grade over high yield bonds. And we would like to utilize more risk at better entry levels, as we believe valuations are expensive, especially for high yield bonds. Furthermore, our base case scenario is for an economic slowdown. So who wants to allocate to weak, high debt level corporate bonds in this kind of an environment? Within investment grade, our preference is for the banking sector. And this sector ticks both the valuation and the fundamental box. In terms of valuation, current spread levels for senior banks are still well above their long-term average spread. On the fundamental side, we have the European Central Bank in Europe monitoring very closely the balance sheets of the banks we are investing in, and this is part of the Basel III regulations. But at Robeco, we don't only take the European Central Bank's word for it. We run our own stress test scenarios to make sure we are comfortable with the risk we are taking on. We want to be rewarded for that risk. And that's simply the way we do things at Robeco, what we call the research-driven approach. Going forward, we believe a safe pair of hands is needed, as volatility will undoubtedly increase. Incidents tend to happen when you have interest rates increase by over 500 basis points, over 5% in such a short period of time. Just go back to this year, March 2023, and we saw what happened with US regional banks. Our research-driven approach navigated us well during that period, and we applied our contrarian strategy and actually increased our risk exposure. We were buying credit bonds at very cheap levels when most market participants were selling. When we look back, we can look at that period and state that that was the correct strategy to apply. Credit spreads have tightened since, and that period of volatility proved beneficial for us. So going forward, we believe that the conclusion from our latest credit outlook is to buy the dips and apply the same strategy that we applied back in March 2023. Our research-driven approach will help us analyze markets and where best to apply that risk budget. As I said, we do believe in being well rewarded for the risk that we do manage.
台新投信优于您的想象，投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。